Okay, so like I was saying, right? SEC, they promote arbitrage as a means to promote to establish efficiency in the markets. These are things that are established facts. It's not, like I was saying before, we're not basing things on imaginary trend lines or imaginary made up support and resistance lines. We're basing things on the real mechanics of the market, right? So we're trying to establish some base facts here so that we know for sure we're on the right path. So how, like, and also just to recap, because I've just started recording, just to recap, like I said, um, we we as retail traders make up only 0.1% or 0.01% of the entire market of a $3 trillion intraday market, right? So given the fact that the market uses arbitrage to promote efficiency, and given the fact that arbitrage is carried out by high frequency trading algorithms, um, it means that most of the participants in this market aren't even human, right? And it's all been done by algorithms and yeah, high frequency trading algorithms, etc., 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 etc. So here's an article here, United Kingdom government, right? Just to prove exactly what I was just saying, high frequency trading and price efficiency, right? And I'm not going to go through all of it, but I'm just pointing this out so that you can see that this is the reality. I mean, it's not just me that's saying it. It's not just the SEC that's saying it. It's the Government Office for Science. They're saying that high frequency trading has a is plays a part in price efficiency, right? Let's see what the summary says. This review examines high-frequency trading and price efficiency. Technological advances typically replace the most repetitive human activity with automation. So there we go. It's confirmed exactly what I've said, right? It's not done by humans, okay? So then if you put that in perspective of a $3 trillion market, right, is it very likely that you have human beings pressing buttons, right, to manipulate or change to put on orders in the market? Of course not. It's just not the way it works, right? Um, so now, what is an inefficiency in relation to the chart? An inefficiency is any area. So let me just mark one as an example. An inefficiency is any area of price that has moved swiftly without giving market participants an opportunity to buy or sell, right? So, for example, in this area here, you can see that it moved very quick and none of the candles returned to that level to offer fair value, right? And so what does that mean, right? Given the fact that, yes, human beings don't trade there, right? Human beings are a very, very negligible part of the market. However, regardless, given everything that I've just told you, fair value has to be offered. It's part of efficiency, right? It has to be this area has to be traded back to by high frequency trading algos. But let's just take all that out of the way. Let's just keep it simple. It's fair value. There's an area of inefficiency. The market has to return to this. Okay. So ICT calls this a fair value gap, right? And it's not something just to be taken at face value. This is why I've given you a big introduction, a big summary on why we take any of these things seriously, not just at face value. Because if someone tells you and draws a line on a map, on a chart and says that is support, and you've got to blindly believe it, then you're not really understanding why you're taking a trade. You're just taking someone's word for it, not really understanding yourself why these things are happening. But what I'm trying to establish here is that there is actually a reason behind everything that we do in these markets and how we interpret them. And I'm trying to explain to you that reason. I hope that's clear so far. So now, so we now understand this concept of fair value. So I can show you some more examples if I go into other time frames. So you can see here, between this area, between this wick and this wick, it's an area of fair value. Okay. In fact, I'll go back further into the price just to show you how this works in practice rather than data that's not really been proven. So let me go back and show you how this really works. So if you look at this area of price, okay, you can see that, let's see, what would be a good area? Okay, every single part of this has fair value, and every single part has been offered at fair value. So let me mark out some areas where we would call it an imbalance or an area of inefficiency. So, like I said earlier, between this area and this area, that is an inefficiency. Okay. And you can see here that at this wick, it comes back to trade back into the inefficiency and offer fair value to the market. Okay. And you can see that actually above this area on this time frame, 2 hour time frame, all the other candles, right, although they've had big movements, the price has always come back to offer at fair value. It's revisited the price to offer at fair value. And the only exclusion in these series of candles here is this tiny little gap here. And look what happens. The market comes back to offer at fair value, right, before dropping off again. And then we can look at this area, this rectangle here, and I'll draw it forward. You can see that in between this wick, the bottom of the previous candle's wick, and the top of the next candle's wick, right? This shaded area here is considered an area of inefficiency. And in fact, let's also draw this part out. Okay. Exact same thing as before. Right. Let me just draw this properly. Right. So one second. Okay. So previous candle's wick and the next candle's wick on this area here. Okay. And you can actually see it again, that what happens is, and then we can also do it for this area, just so that we can be very thorough in examining all the inefficiencies and how this is really true, how this market really does work by these principles. So from that area to this area, okay, right, you can see that the price leaves this area rapidly and it doesn't revisit it, although it offers it at fair value here quite thoroughly down to the body of the previous candle, right? You've got to bear in mind that it has to offer it at fair value, right? It has to give a fair chance to all participants to buy and sell at these areas of price. It's just a rule, a law of the market. And so this wick here, although it did offer it at fair value, it didn't offer it for any substantial amount of time. Okay, so yeah, it did fill this fair value gap, but then you can see further on, later on in time, okay, where do these wicks start and end? Within this fair value gap. So why does it come back? Like I said, it hasn't offered it at fair value sufficiently. So it taps into it once, twice, 3 times, and then it moves. And we can go to this next area of fair value. And I can even do it for this area, I can do it for this area, but I'm just going to stick with what I've shown you, what I've marked out so far. You can see here, the exact same thing happens, area of inefficiency, where price hasn't been offered at fair value. And then you can see further on in time, where does the consolidation happen? Within the shaded rectangle. Why? Because the market has to offer fair value. And you can see again here, within this area, the shaded area, where is the consolidation happening? Like you can see that this wick here ends at this wick, and then it comes back up, offers fair value again at this area. So the point is that what I'm trying to point out is that efficiencies are a rule of the market. SEC encourages it. British government have documented it. This is something that has to be done, and the way that they do that is they use high frequency trading algorithms to bring the price back to these areas of inefficiency and trade them. And so that's why you will see in these areas of inefficiency, you will see the price consolidate around them, because what the market's doing is that the high frequency trading algos are trading within these areas and offering the price at fair value, which is, like I said, it's something that the market has to do. All right, so then that's rule number one, right? The markets have inefficiency, and the inefficiencies have to be filled. They have to be offered at fair value. So that's rule number one. The second rule is that the only way the market can move is through order pairing. So if you let's say you're at this area of price, right? And you want to buy, okay? No, that's not a good example. Yeah, let's say you're at this area of price. No, let's see, let's find a good example. Okay, yeah, this is a better example. So let's say we're at this area of price. Okay, we're at this very high here, and let's say you want to buy, right? You want to take the price up further, right? In fact, let's use a better example. Yeah, let's use this area, right? Because we've got some data to back it up. Okay, let's say we're here, right? And you've got $10 billion or $100 billion, whatever, $1 trillion that you want to put on the market, and you want to take the price up, right? You want to buy low and you want to sell high, right? But you can see that for the last month or so, okay, from April till May, the price has been doing nothing but going up. Okay, so everyone that's involved in the market is currently holding on to a buy from here, from these areas here, all the way up, right? So people are holding on to buys, and for a big whale, right? Bearing in mind that it is just purely big whales in this game, for a big whale to buy at this level in the hopes of selling at a higher price. Okay, they would need to have sellers at this level, people willing to sell at this level to fulfill their buys, right? So in order to make $1 trillion of buys, there needs to be $1 trillion worth of people willing to sell at that price, at this price, in order to fulfill it. Otherwise, what would happen? They would buy, and each each dollar that they spend, it's going to just hike the price up, and so they're just going to be buying and selling to themselves at higher prices all the way up to whatever price they get to. So they wouldn't make any money, right? So this concept's called, I don't know if I've explained it very well, but this concept's called order pairing, right? So they need to have the same number of people willing to buy at this level in order to take the price up, to fulfill their orders sorry, they need enough people at this level to sell in order to fulfill their orders for buys, right? And likewise, they need enough people here willing to buy in order to sell at these levels, right? And so having established this concept of order pairing, right? We now look at this concept called liquidity, right? So in order for order pairing to happen, there needs to be liquidity, right? Liquidity is basically money available in the market. And so, like I mentioned earlier, right, for these 2 months here, it's just been going up in a diagonal line, not exactly straight, but it's been going pretty, so, it's been going up in a straight, in an upwards trajectory. And so there's a likelihood that there are people buying at these levels here, right? And let's say they buy here. There's people buying at this level here. I'll just mark them all up. Right? You have people buying at this level here. Let me delete this. You have people buying at this level here, right? And you have people buying at this level here. You have people buying at this level here. Right? And at all of these levels, okay, you have people who have set stop losses, right? So their stop losses would lie somewhere below that, somewhere below this level, somewhere below this level, somewhere below this level, right? Somewhere below this level, and so on and so forth. This is what you call liquidity, right? And it's a way that the market makers make money, because if everyone's buying and it's going up, and the money has to come from somewhere, right? And it comes from the losers. And so back to this example here, for a market maker to make a buy here is a very bad decision to make money, because there's no one. First of all, there's no orders here. I hope this is clear. I hope I'm not confusing anyone, but they have to have the same number of orders of sells to fulfill their orders of buys. And clearly at this level, through what I've established here, right, it's not likely to be the case. But what they do have is they have a lot of people willing to buy if they were to sell at this price. So you have people here willing to buy, by setting their stop losses below these levels. And if you look what happens to the price, it sure enough comes down and it takes out all these areas of liquidity. Okay, so I hope that makes sense. And that's how the market works. You've just got to, and if you don't believe it, or if you don't understand it, you can message me, or you can say no, and I'll try and explain it in better terms. But you've just got to accept that this is the way the market works. Liquidity and inefficiency. Right? These are the two main concepts that you've got to wrap your head around if you want to trade ICT. Okay, so now we've understood, we've gone through liquidity. I think everyone already understands what liquidity is, right? So we've gone through liquidity. We've established what a fair value gap is or inefficiency in the market is. Okay, so now you might have heard of this term called kill zones that ICT uses. And we look at, so here's a chart where we have kill zones, right? If you lost anyone. Reason why we're using kill zones, right? It's not because it's arbitrary and it's just where ICT likes to trade. There's a really solid reason for it. None of this stuff is based on theory. None of this is just, oh, I like how this looks and, making up some fancy theory behind it. All of this is based on actual financial infrastructure, right? And a lot of people just don't understand it because ICT doesn't explain it. He doesn't tell you the ins and outs of it, right? He doesn't really tell you. He just tells you this is like the way the market works, but he doesn't really explain it in as much detail as I'm going into. But I want you to understand why all this stuff is being used, right? So you can see, right, in the kill zones that ICT defines from London LOKZ, London Open Kill Zone. That's the first 2 hours of London Open, first 2 hours of New York Open, and the first 2 hours or the last 2 hours of London session, just before London close. You can see that if you look at this area of time, right, from 3 a.m. UTC -4 time zone, that's New York time. You can see that the market all of a sudden has a huge spike of volatility. And when does it end? Exactly at the end of ICT's defined London Open Kill Zone. You can see in the next spike of volatility, it happens almost exactly at the start of New York Open Kill Zone, and it's just a straight drop all the way until the end. Okay, that's one example. You can look at the previous day, and it's the exact same thing. Yep, London Open, slight drop, delivery of, okay, so this one's a wee bit weird, but regardless, you've just got to take this as a fact. It is the way this market works, right? You can look at the previous day, the day previous to that again, starting London Open, not much decisive direction up until London Open, and then you get that big spurt of volatility. And then you get the close of, you get the end of London Open Kill Zone, and then it starts to fizzle out a bit. And you go back to the start of New York Open, and then you get the big spurt of volatility again. Okay, so why do we use these kill zones? Why do they matter? All right, the reason why is because the market is run by CLS Group, right? CLS stands for Continuous Link Settlement, and you can see, let's see, it even sits on our homepage, I think, if I can get it to run. CLS is a standardized automated bilateral payment netting, whatever that means. I hope that makes sense to you guys. The global standard in FX settlement mitigation, streamlined across settlement related processes. Right. So cross-currency swaps. Look at this. 6 trillion US dollars settled on average every day through CLS Group. 70 plus settlement members, right? So where do you think any of the price action, the volatility in the foreign exchange market is coming from? You think it's from Goldman Sachs or Morgan Stanley or national banks? No, it's got nothing to do with that. It's all being processed and settled by CLS, continuous link settlement. Where in any other trading course do they mention this? Do they teach you this? Nowhere. Right? And if they're not telling you this and they're telling you that it's to do with some stupid stuff like some pattern or break a structure, something like that, they don't know what they're talking about. All right. This is the real reason. This is the real thing behind the real driving force behind the market. So now let's look at this. CLS settlement. All right. So mitigate settlement risks. So this is more for big countries and stuff like that. It's more for, I mean, if you've got like several $1 million, then you might want to go for a CLS settlement. But let's just give you some example, some concrete evidence why we use these kill zones or these particular times. CLS settlement schedule. Okay, so let's see some additional info. The CLS settlement process flow is for member banks to send their foreign exchange transaction information to CLS during the day, after which CLS creates a schedule of net payments that the member banks must pay to CLS. All right. So it means, in plain English, what it means is that these banks, the national banks, send their money to CLS and they say, look, we want to buy XYZ, right? And then CLS determine the most efficient way for them to buy and sell their currencies, right, on the market. They submit it to CLS. CLS then creates a schedule of payments, right? So it means everything is predetermined. It's determined beforehand, right? They basically predetermine this stuff and then it gets executed the next day by algorithms. It's got nothing to do with perceived support and resistance or trend lines. It's got nothing to do with that. So anyone that's talking about these kind of things, they have no idea what they're talking about. Okay, so now let me see. Where was that? I showed it to Lucky the other day. Yeah, okay. Operational timeline. Okay. So how does this timeline work, right? We operate 24 hours a day, and you can see here that their timeline starts at 8 p.m. Central Eastern Time, and it finishes at 8 p.m. Central Eastern Time. And this is the only timeline they have. What does this mean? It means that every single day, it's the same schedule repeated over and over and over again. And so we only ever trade on an intraday basis, right? Everything happens on an intraday basis. And it says here, credit derivatives, DTCC cash flow submission window for the next settlement day. So it means between 8 and 8:45 Central Eastern Time, right? They've already they will calculate their plan of action, the price action for the next day, which is to be executed at the settlement time. Start of settlement 7 a.m. Central Eastern Time, finishes at 12 p.m. Central Eastern Time. Right? You don't need to look too far into this. I'm just giving you this to give you to so that you know this is really how it works. Right? And none of this is like bogus theory, stupid trend lines, stuff like that. This is really how the market works. No bullshit. Right? You can see it yourself. Look, I've given you, like, I'm going to post the video. You guys can go through it. You can look all this stuff up yourself. You can see this is really how it all works. There's no bullshit like pay-ins, payouts. All of this stuff is predetermined. Right? And I can actually give you examples of how this actually works. I can show you how it really is predetermined, but we're not going to go that far today. So now we've established, right? So just to recap quickly, we've gone through the fact that the market has to operate at fair value, has to provide fair value. That is essentially a law of the market. Right? We've established that the market makers can only make money through liquidity, taking liquidity, and having order pairing in order to fund their trades. Okay? And then we've also established that the market operates on an intraday schedule. Okay, it's not long term. It is long term, but not in the way that we understand it. But it operates on an intraday schedule. So it means every single day we take as a new day and we trade on the basis of that day. Okay. So, and then we've also established we've also ascertained that there is a settlement windows, which ICT has called kill zones: London open, New York open, London close. These are things that are facts, and you can't dispute it. You cannot dispute this. And if you do dispute it, it means you don't understand. You don't understand the financial market infrastructure. Okay, so the way that the market trades, right, is that it has to, on a daily basis, every single move, all that's really happening is that it's rebalanced, it's taking liquidity, taking available liquidity, i.e. taking out stop losses, and rebalancing the market. And that's what every single move in this market does. It does nothing other than rebalance, take out liquidity, then rebalance, and take out liquidity, and rebalance. And how does it do that? It does this by taking out liquidity, like I mentioned, areas where there are likely where there is likely to be liquidity. We can learn how to identify that later. And rebalancing on fair value gaps, which I've explained to you guys, right? It's any area that's moved fast. So yeah. So now, how do you apply this, right? So you want to look at every day as a new day. You want to use previous days reference points, right, to take into consideration for your current day analysis. And so what I'd recommend doing is setting your current time zone to UTC on TradingView. I don't know how to do it on my mobile, but you want to set your time zone to UTC -4. And I recommend having these indicators on. So I would recommend using ICT everything by this guy here. I recommend using that time zone UTC -4, and I recommend having this indicator FVG nephew Sam, and having these, I would have two instances of it, one for these time frames, right, and another instance for other smaller time frames. So I have another instance of this for 2, 3, 1 week and 1 day time frames. And then what have I got here? Yeah, you don't need this. Anyway, so what is it? The FVG indicator basically saves you from having to draw them by hand, and it draws them onto your chart for you. So if I were to go to, let's just look at daily, right? It's already drawn all the fair value gaps for me. And so let's just take an example here of fair value gaps in action. So you can see here it's drawn a fair value gap from here to here, and you can see that it trades down below it, and then the next day it trades right into the fair value gap. But look at the wicks. This wick touches this wick exactly, right? And then it wicks down. So in that time, on a daily chart, you've got like maybe 200, 300 pips of movement. Maybe not that much, I don't know, I'm not counting. But you've got quite a lot of movement here from that wick, the top of that wick to the body of the candle, right? That's a lot of movement. And that's just a reaction where the market has provided fair value and it's dropped down. And now that it's provided fair value, it can come up and it can do whatever it wants, right? And in this case, it touches here. I'm not sure why it didn't like offer fair value for the entire this entire fair value gap, this entire inefficiency. It happens sometimes, but you know, so that's like maybe the way that the way to interpret this is that it's not really offered fair value at this area yet. It's just come up and it's taken out liquidity resting above here. So yeah, what you want to do is you want to have these fair value gap indicators on. You want to have ICT everything indicator on. And what that does is it draws out daily dividers for your price so that you know you can easily distinguish between previous day's price action, which is anything before this line, and the day, you know, the current day. Anyway, this is a daily divider, so you can see, you can easily distinguish between previous and current day's price action. And what you want to do is you want to look into, first of all, yeah, I'll go through psychology later, but you want to basically start off the day, right? So you want to choose a kill zone that you want to trade. I personally prefer London Open. I find it easiest to trade. And you want to basically sit there around half an hour before London Open starts, right? And if you want to know what time London Open kill zone is, you can look this up. I don't have it to hand right now, or it's on the indicator that I've given you guys. You want to sit there before London Open, and you want to have all your fair value gaps marked out. And so this one's not too good this day. It's not too clean. It is clean, but it's more advanced. Like I don't want to confuse you guys too much. I want to give you some more simple examples so you can really see what I'm saying. Yeah, this is a good example, I think. Yeah, this is fairly good. Yeah, in fact, it might be easier if I just give you something that use a higher time frame. So you want to be very, very selective on your trades, right? You don't want to be, even though it's an intraday, like we've established, the settlement schedule's intraday, you want to be very selective on your trades. You want to, it's not about, don't get greedy and don't try and trade every single day. And, although you could, if you get good at this, right? If you really start understanding everything and how the algorithm really works, you can keep this very basic and very simple, and you can still walk away with really good results. The way you do this is you rely and look for um, higher time frame fair value gap. So a good one, if you want to be very, very, if you want to keep this very, very simple, right? Just as an example here, I mean, 4 hour fair value gaps are brilliant for trading. So let's show you an example. So this one here, look, you can see this fair value gap here. Okay. Um, and it's a shame I'm on my mobile because I'd like to show you this in relation to an intraday price delivery. But what you want to have is, let's say this area here is your London Open kill zone, right? Right. So what you want to do is, I've got to go in 5 minutes, so I'm just gonna round this off, right? Just really quick summary of the trading strategy. So let's say your day starts here, midnight starts here, your London Open kill zone starts around here, okay? And you're sitting there about half an hour in or an hour before, looking at the charts. What you want to do is you want to mark out a fair value gap, a higher time frame fair value gap. The higher the time frame, the more reliable it is. So if you want a really good solid one, I would say 4 hour, 1 hour maybe, 2 hour, 4 hour and above, right? And so in this case, we're using 4 hour. Let's say you're at this area. This is the time you wake up. You look at the charts. You're 1 hour before the kill zone starts. You do your analysis. So then you've got your fair value gap indicator. It's showing you a 4 hour fair value gap. You see a 4 hour fair value gap. That's brilliant. Now you've got your potential area of interest, right? Your point of interest. Okay. So now you've identified it. You're looking, like I say, the market always takes out liquidity and rebalances. So let's say the day starts here. No, let's say no, that's a bad example. Let's say the day starts here, right? On this black line, right? You've got all this liquidity. Um, you've got all this liquidity built up from the previous day, right? So the day starts here, new settlement schedule started. What does it do? It comes up, takes out previous day liquidity, and then, like I say, before London Open, you've seen that it's taken out liquidity. It comes into the 4 hour. You've marked out a 4 hour fair value gap. You've identified it, spotted it, and now what you do is you wait for London Open to start, and you wait for the reaction. So you sit and you wait patiently for the price. You don't touch any buttons. You don't put on any trades until it comes up and it fills your fair value gap. And you can see even on the 4 hour, the level of accuracy, right? The wick touches this wick exactly. When you see that happen, that's your time to enter a trade. and you can take a sell, and you can aim for previous day sell side liquidity, or sorry, this is called buy side liquidity. So the liquidity on the other side of the market, which is around here, and you aim for that. So you take the sell from the reaction of the 4-hour fair value gap within the London Open kill zone. Okay, why are we using the kill zones again? Because this is the settlement schedule, the settlement window for that's defined by CLS. This is exactly how the market works. And so they hit this area within the kill zone, and it sells off, takes out the liquidity. That's where you should probably aim for your take profit, and boom, you've got your day's trade. And that's just a really simple way of explaining it. I can go into more detail next time, but I hope that makes sense, guys. And yeah, I hope that makes sense to you guys. I know I've gone into a lot of detail, but yeah, I've got to go for another meeting now. So, if you guys have any questions or anything, like there's the ICT discussion group. You can just post your stuff there, and I'll try and answer everything I can. I hope that's clear. Hope everything's clear. And yeah, just let me know if you've got anything. If you've got any questions. Lucky knows he's starting to learn. I mean, I only started teaching him 2-3 days ago, but I think he's had some previous experience, so he knows a little bit about this stuff. Rayhan understands this stuff as well. So if you want to ask them as well, they can help you. And yeah, like, so what I recommend is from now onwards, you should really spend some time with these fair value gaps and looking at the reactions of them within the kill zone times, and really seeing for yourself that this is really the case. This is really how the market works. When you start to see it yourself, then you're going to find this a lot easier. You're going to start to see how easy this trading really is. So yeah, I hope that's clear to you guys. Last example here. You can see on a 5-minute, you've got this tiny little fair value gap from here to here. I'm not drawing it very well. Yeah, from here to here. All right. Okay. And just okay, I mean, it didn't happen exactly in London Open. I can there's things outside of, there's more advanced rules I need to teach you, but you can see that more or less within London Open, right? It touches this tiny little area of inefficiency and then proceeds to deliver a crazy amount of volatility for the next hour. All right, and where does it take? It takes previous day's liquidity marked by this line, right? This line here, previous day's liquidity, the previous day's high, where there's likely to be a lot of sells all the way down. So you've got people that are saying, oh yeah, it's peaked, that's the top. And they're hitting the sell button, right? People just guessing, idiots with all their stupid theory that doesn't really make sense, or it doesn't even conform with the way the market works, right? They're hitting the sell button all the way down. And what happens? The algos decide, no, this is where the money is. This is where the sells are. They order pair. They put in their buys, and the price jacks up. And they take out the liquidity, take out the sell stops, stop losses all the way up. So yeah, that's it for today, guys. So I hope I've explained things clearly enough. And like I say, Any questions, yeah, put them on the discussion group. And you just got to practice this, go through your data, go through as much as you can, and you will see that it really does happen every time, every single time, every single day, every time. It does the exact same thing. And that doesn't mean that you should go and trade it, right, every day, because you've got to practice this until you've got a sense of what you're doing. I mean, this is another example. You can see that this daily fair value gap that's marked out, it's not a fair value, it's not, the fair value gap doesn't go all the way up here because this is a 5-minute chart, but on the daily, there's an overlapping fair value gap that fills this region of price. And if I expand this, you can see that the high here, right, was formed, it fills the daily fair value gap pretty much at the start of New York Open, and then it just proceeds to drop for the next, well, it drops until it takes out this area of liquidity, right? So that's what you want to look for. You want to see overlapping higher time frame fair value gaps on a smaller time frame chart. So you want to be looking at 5-minute, and if you're really good, you can use 1 minute. And you just want to get used to seeing the fair value gaps being filled, the higher time frame fair value gaps being filled, and the appropriate reactions. Okay, so I've got to go. Yeah, have a good day, guys. Thanks for listening, and yeah, feel free to ask me any questions later on. Cheers. Bye bye.